The bulls claw back on Dalal Street. On Friday, the Sensex gains 900 points, the Nifty up 300 points, posting its biggest single-day gain in 2023. On this week's episode of Editor's Roundtable, does the pullback have more legs? A deep dive into the FII positioning, and as the mercury rises, what are the stocks to watch this summer? I am Reema Tendulkar. With me, I've got Prashant, Nimesh, Nigel, and you're watching Editor's Roundtable.
Well, outstanding week, right, guys? I mean, outstanding Friday, I should say. And 1% for the week, but it felt like so much more, especially given what happened on Friday, that is. And
that's why there's a saying, right? All's well that ends well.
That's true. I don't know. I mean, are we making? I was just wondering, and we were discussing this on closing as well. Are we making too much of? Because it's a one-day thing so far, right? But I think the fact that this entire Adani transaction has taken place and retail sentiment was down, and Anuj put out that piece last Friday that retail was feeling out of the market, and the fact that I mean, this is a big event, right, which has kind of picked up sentiments a little bit, those so-called animal spirits. One can sense that maybe it's coming back. I don't know. We'll have to wait and watch. But it was a good day after many, many dull down days.
No, I'll tell you what, at the start of the week, even though the Nifty was under pressure, you're getting sense that the broader markets are outperforming. So I think at least retail will feel a little bit better. And there was a big party at the end of it on a Friday. So good to see, actually, that we at least fought back a little bit. And sentiment, at least for the time being, seems to have changed.
But we're still within that big range, right? That 17,850, 17,900. Still, we've not crossed it on the way up.
You know, we keep saying in the market, right, 1 week is too long. I think this week has shown everything. The way up Adani has raised money. Friday itself, we've turned positive from negative for this week. Just one day. And I guess this week's move in many of the stocks has actually changed the sentiments for the retail investors as well. And the simple reason is, for many investors, forget the traders, but even for a lot of investors, this week's move has helped them to be a bit of a relief. Because M2M, they're slightly better. From losses, they're turning into green. So I think that's at the margin is going to help the sentiment as well.
I think even beyond M2M and those kind of things, I mean, it just sends the message. It's an up market. Everybody likes a green market, and it sends the message that I was thinking of that dialogue from Three Idiots. All is well. I mean, it may not all be well, but at least for one day, it just felt like it was up.
Prashant, you've got to do this when you do that.
And Prashant, in markets, we talk about fundamental technicals, fundamentals, everything. But I think sentiment plays a big part.
Oh, 100%.
You know, just when you have some bit of confidence back, I think markets react that way. So I guess that bit of sentiment is back, bit of that confidence is back. So same time last week, the feedback was there was extreme pessimism and fear in the market. I think from that extreme pessimism and fear, there's a bit of relief or a hope in this week.
So the question is, what next, right? Does this pullback have more legs to go?
I mean, so let's look at the global and the local data, and that's what I'm going to do. Let me just hop across to the big wall to explain. What I'm going to do is first start with the global, but this is essentially how I'm kind of putting this out. Does positioning indicate that there is perhaps a chance for a meaningful bounce, right? That's the question. So this is just kind of recapping how the mood in the market has changed. These are the three biggest things we track every morning when we start, the bazaar, the morning show. And look at this. In January, the sentiment was that we'll land very softly. I mean, it'll be a gentle landing. There will be no hard landing. Things will be okay. Things will work out, right? The S&P went up 6%. The 10-year went down 35 basis points. The dollar was down 2%. In 1 month flat, because of the data, very hot data out of the US, which is jobs data, services PMI, jobless claims, and many others, all in the last 1 month, it became from soft landing to no landing. What do we mean by no landing? That the economy will continue to do well, which means that the Fed will have to fight a longer fight. And this is what happened as a result. It completely flipped. The +6 became -3.7, -35 became +45, and the dollar from -2 went up 2% plus in the month of February. And we are starting March now, pretty much continuing where we left off in February. Data is still strong, right? And this is the worry, really. This is the main worry for global markets. This is the US 2-year yield. And this has got data all the way back going 2006. And as you can see, it is broken out. It is broken out of some significant levels. and it is surging. And I could have put out sort of charts for the 10-year. It'll give you a similar kind of picture across tenors, basically 5-year, 10-year, 30-year, across the board, yields are surging. And this is not good news. Let me just tell you what the worry is. The worry is if we are going to see a regime of higher for longer, which is rates go up and they stay up for longer, it leads to the following, in a way, negative externalities, right? There is demand destruction, which is negative for companies. Margins are hurt. There is higher interest cost for levered assets, especially things like real estate, etc. And there are asset write-downs and credit losses as well. Just this week we saw, trouble at a Blackstone fund, right? So this is what this is the cost of higher for longer. If we are to see that, this is what the market fears. Now let me tell you the other side, why many are saying that perhaps there is hope. What is the hope? Some of it is technical in nature. First of all, like any market, the rates market in the US is also looking extremely overbought. Across tenor, 2-year, 5-year, 10-year, 30-year, things are looking very, very overbought, oversold, depending on what you look. Which means that it could limit the significant further upside, at least in the near term. So the 10-year is at about 4%. Is it possible because of these conditions we see a pullback? I would say yes. The other thing, this is the technical reason, the breakout in the 2-year yield has not yet been confirmed by the 10-year or the 30-year. So sometimes these things matter, all right? It's not as if the entire yield curve is pushing higher with the same ferocity. The Fed's terminal rate pricing remains a moving target. It's, of course, dictated by data. You just need 1 or 2 weak economic data prints to show that things are cooling up a little bit. The economy is cooling up a little bit, and it'll be back to sort of, the soft landing environment I described, which was prevalent in January. So it doesn't take much to change the sentiment. Now, let me just quickly get to the local data point, right? The numbers tell you everything. So what I've done is I've taken what FII net short positioning in the market is. You can see 4 instances. The last one is now. As of yesterday, the net short position of FIIs was about not 1.34, 1.31 lakh contracts. You look at the previous instances, October 2022, 1.37, June 2022, 1.46, and May 2022, all of it about more than 1.2 lakh net short contracts. This is the change 30 days later, right? June, of course, June and October were more significant, and this is 60 days later, 2 months after this, what happened? As you can see, markets in all 3 instances rallied to varying degrees. The question is, we already, by the way, have today's rally, which is about 1.5% or so. What next? Could this become bigger is the question. I reckon the mood is negative. People refuse to believe that perhaps we will see a big global, we'll see a meaningful rally, not a big, but a meaningful rally in the face of all the global worries. But markets are known to surprise, and I leave you with that thought. Let me toss it across to Nimesh, who's, of course, got the pulse of what dealing rooms are talking about. Nimesh, over to you.
No, Prashant, from a dealing room or from a market's point of view, as I said earlier as well, the mood has clearly changed from extreme pessimism and extreme fear to a sigh of relief. And why I'm saying is, I'll just try to explain with some data as well. There has been a bit of outperformance in the broader market, so that's helped the sentiment. And also some bit of momentum is back in some of the momentum stocks. So look at Adani Enterprise for this week. On Monday, it hit a low of 1111. And on Friday, it closed at 1890, more than a 50% move in this particular stock. Of course, the news about fundraising has helped, but there has been a bit of an uptick in that particular stock. Similarly, was the case with Macrotech Developers. This week, Macrotech Developers has rallied 42% after hitting a low of 711 on Monday. So, clearly there is a bit of momentum back. And for the entire week, the feedback was that while the Nifty and Sensex are range, there is a bit of outperformance in the broader market. So that's helping. The last bit is the Friday rally in the bank stocks. That was one thing where a lot of investors were overloaded, and now you're seeing a bit of a relief rally in the bank stocks as well. So that's also going to help a lot of investor sentiment at the margin because they were stuck in many of those things. But now the big worrying factor for the market has been the supply overhang, and that continuously is going on. We saw big stake sale from SoftBank in delivery. We saw big Adani Group selling 3-4% stakes and raising 15,000 crores. My sense is this trend is going to continue maybe next week as well. So there is a lot of feedback that at least 4 to 5 large blocks are in the pipeline and can work out next week. So that's going to be a supply overhang. But I guess from a sentiment point of view, there has been a shift from sheer fear to a bit of sigh of relief, given the kind of rally we've seen in this week. not only in the broader markets, but in the Adani groups as well.
All right, Nimesh, thanks very much for that. But we're all bracing for a hot, scorching summer, right?
You're feeling the heat, right, already?
Yeah, that's right. But with every adversity, sometimes it throws up an opportunity, right? So let's focus on that then. I'm just looking at what SkyMet had to say about February. We're only in February and we're talking about the heat. And, we've had the hottest February that we've seen all the way since 1901. And they're saying, SkyMet goes on to say that in the coming months, that's March, April, May, it'll only get hotter from here on and we could experience some heat waves. So putting that into context, well, we said, let's look at a couple of stocks and let's look at potential beneficiaries. Well, the direct beneficiaries obviously is going to be, if it's going to be so hot, then you're going to be looking at, AC makers, you're going to be looking at fan makers in there. Havells, well, they'll qualify in both ACs as well as in fans. And if you're looking at coolers, then Symphony comes into play. So these are some of the companies that could be in focus. And we've already seen some of these stocks, like a Voltas. It's been quite strong after losing market share and reporting really dismal margins. So there appears there is some pre-buying that's playing out as well. Refrigerant chemicals as well, like SRF, they could be another beneficiary of that particular play. Now, we here at CNBC-TV18 had spoken to Tata Power's top boss, Mr. Sinha, and he said that he's expecting power demand to clock close to around 230 gigawatt. Remember, the last year in summers, it was around 210. So he's expecting a 10% increase. He goes on to say that even globally, power demand goes up by around 1 to 2%. In India, it goes up by around 3 to 5%. But he's saying that in this summer, we could see it go up by as much as around 10% odd. So clearly, power demand is going to be strong. I also was tracking the IEX, DAM. That's the daily traded, price per unit. And out there, in the last few days, you've seen that the per unit cost has moved up substantially. So that's as well telling you that there could be some potential beneficiaries if someone hasn't tied up their power. And so let's focus on a couple of those stocks. JSW Energy, we had the management who joined us over here. And they said close to around 17 to 18% of their total supply or their total power is not tied up. So they would enjoy merchant rates. The others, yes, they would be beneficiaries like a Tata Power, NTPC, etc. But most of their power is regulated. So that's why we're not focusing on that so much. Besides that, well, if there is a big surge in terms of power demand, then discoms could be forced to buy power via the exchanges. So then IEX could gain on the volume parameter. While Coal India, because of higher power demand as well as higher e-auction prices, that could be another potential beneficiary. But what if there is a power deficit? Then we're looking at another angle. Diesel genset makers like Cummins as well as Kirloskar oil engines, they could be potential stocks you look at. While UPS and inverter makers as well. Hopefully we don't get a deficit, but if in case that is the scenario, then some of those, V-Guard, you have Exide as well as Amara Raja. But guys, don't take it so seriously. If it's going to be so hot, what are you going to be consuming? A lot of ice cream, maybe drinking a lot of beer, and bottle demand as well could go up. So maybe Varun beverages and all. So we just said, in every adversity, sometimes there is some opportunity that comes up, just highlighting the stocks that could be in focus. But Rima, it's not just the hot summer, right? You're talking about drier monsoon as well. Which are the stocks that could get negatively impacted?
Well, absolutely. The specter of El Nino is also possibly looming in front of us. Now, according to a leading global weather forecaster, NOAA, that's National Oceanic and Atmospheric Administration, they're saying there's a 55 to 60% probability of an El Nino this year. And El Nino historically and typically has been accompanied by deficient monsoon. So which is where the drier monsoon comes in. And if that is the case, then there are going to be a few stock sectors which face some challenges. So the first one is going to be agrochemicals, because a deficient monsoon impacts sowing, it impacts cultivation, and therefore it will negatively impact the demand for fertilizer and pesticides. So names like Coromandel, Sumitomo Chemicals, PI, UPL, Fluorochemical, Tata Chemicals should be on your radar. Then the obvious ones, stocks which are exposed to the rural economy. Now, the rural economy is already under stress due to higher inflation. If there is a deficient monsoon, then inflation goes up, but also farm incomes get affected, which means demand for tractor makers, two-wheelers comes down. NBFCs, which lend to the rural economy, like MMM, FSL, Mahindra and Mahindra Financial Services, L&T Financial Services, Shriram Transport, keep them on your radar. Consumer goods, the Dabur, Godrej Consumers, Maricos of the world, paint companies, and also pipe companies. These are all the companies which are linked to the rural economy. So that's a space that you need to watch. In fact, UBS analysis also show that Indian FMCG large caps have shown a clear deceleration in revenue growth in the last El Nino episode, with the year-on-year revenue growth falling from 10% plus to 0. Another space to track will be the hydropower, because there could be lower hydro generation if there is a deficient monsoon. So NHPC, and this may be a bit far-fetched, but IPCA Laboratories has also been flagged off by UBS because they're saying there could be lower demand for anti-malarial drugs if the monsoon gets impacted this year. So IPCA Labs is another one. So this is just a ready reckoner that, what could lie ahead if indeed El Nino does play out. Early days, but if El Nino happens and there is a deficient monsoon, there could be some stocks which get impacted.
By the way, good piece, both of you. But at least for all of our sake, I'm hoping that you guys remember what happened. Everyone was expecting a super cold winter in Europe.
Oh yeah.
Yeah,
The winter never
Let's hope it doesn't take place, right? I mean,
But the weather is crazy.
So exactly, for me, I think the big takeaway was that for Nigel, another reason for helping United Breweries to do well. So I guess,
but it's not working, Nimesh. It's not working. They posted such dismal results. I was wondering, you have to do something more, I guess.
You should really do something.
No, but the weather. I mean, I was talking to somebody in San Francisco now on the west coast. It's actually cold. I mean, it's freezing. In Europe next week, apparently, in some places, temperature is expected to be in the negative. And of course, we are reeling with this heat wave.
Topsy-turvy. But with that, we're going to slip into a very short break. On the other side, we'll invite Pankaj Tibrewal, Senior Executive Vice President, Fund Manager of Equity at Kotak Mahindra AMC.
Welcome back. You're tuned in to Editors Roundtable here on CNBC-TV18. And as promised, let's get chatting with Pankaj Tibrewal, who joins us on the show. Hi, Pankaj. Good to speak to you as always. Before we went into the break, we were talking about a potential heat wave, maybe lack of monsoons as well. But you must be under fire, right? Managing $3-4 billion odd, and these markets have been so volatile. Do you think that there are some themes that you would be looking at if there is a deficit in power, if there's going to be, a drier than expected monsoon? Will that present a couple of opportunities? We were highlighting stocks like JSW Steel, IEX, and the likes.
So yes, Nigel, I think what we have been saying over the last couple of years is that investment cycle this time around looks for real. And let me share you a few data points which probably could be very interesting. If you look at the entire order book, book-to-bill ratio of most of the infra and capital good companies, they're at almost all-time highs. And we are seeing push from government, we are seeing push from state governments, PLI it's doing its bit, and private sector has started to show signs of capex kickoff. Also, we analyzed 136 companies on engineering and capital goods. And you'll be surprised to know that in 2022 fiscal year, 80 companies had their highest all-time revenues, and 41 companies had highest all-time profits, earnings in a year. And if you take it forward to the first 9 months, about 13 companies in engineering and cap goods had highest revenue in a year. And about 40 companies again had the highest earnings in a year. So I think clearly this time the momentum looks to be great on the investment cycle. And also a very good piece you have spoken on the power sector. I think the demand is increasing between 7 to 10%. And supply has not kept pace with it, especially the thermal power side. And I think at some point of time, it will reflect on the power pricing. Already in month of Feb, you are seeing average daily pricing about 8 to 9 rupees, which has not happened in the past. And the summer is yet to come. So I think over the next couple of years, we could be looking at a scenario where there could be power cuts, again, seasonally though, because solar and wind have their own limitations. And you need incremental thermal power plants. And next 3-4 years, you will not see any new supply coming in. So power sector could be an interesting overall theme. And overall investment cycle still looks to be strong. And that's remains one of our top investment ideas overall from a portfolio perspective.
Right. Pankaj, as an investor, as a fund house, would you look at the sort of investments in the Adani Group, not because of what GQG has done, but the fact that that just gives me a prompt for this question, which is the fact that stocks fell quite a bit. and they see value. I mean, right? I mean, they're a large global equity fund. Are you guys doing the same? Will you guys do the same with the group after the fall that we've seen?
Prashant, you would appreciate that we don't comment on individual companies or groups, and I would keep it at that because in the past also we have spoken about themes, sectors, but we will refrain from commenting on any group or any company.
Sure. Pankaj, Nimesh, you've been a little cautious on the market for the last 2 quarters. After the numbers that we've seen in Q3 and the stocks have corrected, do you see now there is an opportunity to nibble into the broader markets, especially in the mid cap and small cap?
Nimish, I still believe that at least 6 to 8 months more of consolidation and time correction is there.
Oh.
But I'll have my view that this is a year of deployment, and I think this is a year of moderate return expectations. And the reason I'm saying are because of 3 data points. Look at the Q3 numbers. On the headline NSE 500, you saw 6% earnings growth, and entirely it was led by BFSI. The non-BFSI segment, which is 415 companies, again had an 11% decline in profits. And the same exactly holds true in the first 9 months, where the headline basis profits grew by 7%, led by BFSI, but the non-banking and financial services actually saw double-digit decline in profits. So I think broader market is more about, rest of non-BFSI segment, more manufacturing, services, and so on and so forth. And that's where the concern is. I think 2 more quarters where earnings downgrade cycle will be digested in. But let's appreciate the fact that 18 months have gone by without any return in the markets. Virtually the markets are flat and portfolios are down by 10 to 20%. And let's appreciate another fact that if you adjust for the earnings growth and multiple contraction, markets are actually corrected by 35%. So incrementally, I think it will be not right to be very negative on markets. I think selectively there will be opportunities coming in over the next 2 quarters. And I still believe that this year will be a year of deployment where the benefits would be reaped in 24 and 25. So selectively start looking out for opportunities over the next 1 or 2 quarters, where whenever there's earnings disappointed, franchises are good, and companies have a strong medium-term thesis from a growth perspective. I think you'll not be disappointed from a medium-term perspective.
You said, Pankaj, we have 2 more quarters of earnings downgrades ahead of us. Which are the sectors where you see maximum earnings downgrades from here on?
So I think consumption still is soft. I think, and still the expectation by the street is much higher. And also for the broader market, if you look at the expectation on earnings growth is still on the higher side, we believe. And there could be sectors from a consumption, discretionary, maybe at some point of time, autos. Probably right now, autos are doing well. But if discretionary is seeing such sharp slowdown, it can see a spillover on auto side as well. And probably metals and oil and gas is hard to call by. But I think the earnings upgrade cycle is something which we are not looking there as well. So I think Nifty earnings, if you look at 960, 970, the street is expecting. We believe there could be some more downside before we settle in out from an earnings downgrade cycle perspective.
Pankaj, thank you very much for joining in. Pleasure speaking with you. Have a wonderful weekend. With that, it's a wrap on this edition of Editors Roundtable. From the entire team, thank you for watching.